Before we go any further in this series, we need to reset how you think about options. Options are not lottery tickets. They are not bets. They are contracts. And every single options contract, no matter the stock, no matter the strategy, is built on the same three things. If you understand these three things, everything else in options becomes easier. If you don't, this is where people get hurt. In this video, I'm not teaching strategies. I'm not telling you what to buy. I'm teaching you what you're actually agreeing to when you click buy or sell. Because once you understand that, you stop guessing and you start making intentional decisions. Let's start with the strike price. The strike price is the decision point of the contract. It's the price where the option starts to matter. For a call option, it's the price the stock needs to be above. For a put option, it's the price the stock needs to be below. But let's be clear, this is where the contract starts to accelerate and how valuable it is. Whether you buy an option above or below the current share price, as long as the direction of the movement aligns with the option, it will gain value. As it passes the strike price, it accelerates in value. This is where beginners usually misunderstand things. They think the strike price is the price the option will trade at. It's not. It's the line in the sand the stock has to cross for the option to become valuable. So when you choose a strike, you're making a statement. I believe this stock can get here. Not someday, not eventually, by a specific time. That time brings us to the second part. Every option has an expiration, and this is where options become dangerous for beginners. Expiration is not just a date, it's a clock, and that clock is always ticking against you. The closer you get to expiration, the faster the option loses time value. That's why short-dated options move so violently. They can pay fast, but they can also go to zero very fast. Now, I personally trade weekly options all the time, but occasionally will trade shorter expiration dates. But here's the difference. I understand what I'm trading and I manage risk aggressively. If you're new, same day or 1 day to expiration options leave no room for error. One wrong candle, one pause, one pullback, and the trade is over. So when you choose an expiration, you're deciding how much time you're giving yourself to be right. And time matters more than most beginners realize. My recommendation, choose the weekly option contract. Those are the ones that will expire on the upcoming Friday. If you are trading on a Thursday, you should consider looking 1 week further out. If it is a Friday, absolutely choose at least the next Friday. At all costs, unless you are very experienced, do not trade contracts that expire on the same day you are trading. The third piece is the premium. This is the price you pay for the contract, and this is where people get fooled. They see a cheap premium and think this is low risk. It's not. That premium reflects two things: how likely the option is to work and how much time is left. Later in this series, we'll break premium down into components. For now, just understand this. The premium is the market's opinion of probability and time. When that opinion changes, the price changes, even if the stock doesn't move much. That's why options can lose value while you're technically right. Now let's put this together with a simple example. Let's say we're looking at NVDA. NVDA has weekly options, not daily expirations, which already makes it more beginner-friendly. When you choose a strike, you're choosing where the stock needs to go in expiration, you're choosing how long it has to get there, and the premium tells you how expensive that belief is. Change any one of those, and the entire trade changes. A farther strike is cheaper, but less likely. A closer expiration is cheaper, but faster decay. A longer expiration costs more, but buys you time. This is the trade-off. There is no free lunch in options. This is where most beginners get trapped. They pick a far out of the money strike with very little time because the premium looks cheap. That's not low risk. That's low probability. And low probability trades feel fine until they don't. Once you understand strike, expiration, and premium, something important happens. You stop asking, how much money can this make? And you start asking, how likely is this to work? And what am I risking? In the next video, Options 103, we're going to talk about in the money, at the money, and out of the money options. And that's where probability really starts to click. If you remember nothing else from this video, remember this. Options are the path to big paydays, but without rules, understanding, and risk management, they will take your money just as fast. This series exists so you don't have to learn that the hard way. Watch Options 103 next, and we'll build on this foundation. Stay patient, stay disciplined. I'll see you in the next one.